Yeah, hello everyone. This is CS Sai Akash from Hubli. So now we'll be starting with CA Intermediate Financial Management quick revisionary videos. So the intention behind recording these videos is to give you an overall summary of the entire chapters along with the formulas and a bird's eye view for your exam preparation. अगर आपको लगता है कि आप सिर्फ और सिर्फ ये वीडियो देख के CA इंटर पास हो जाओगे तो आप गलत हो। सीए इंटर पास होने में स्पेशली एफएम पास होने में आपको प्रैक्टिस बहुत ज्यादा करना पड़ेगा बिकॉज एफएम इज अ प्रैक्टिकल पेपर. So these are just a theory concepts for you to quickly revise the same because every time you cannot open your module or class notes and revise. To make your life easier, we are recording these videos. These are only for your help. Don't assume that only by watching these videos you'll be able to clear CA exams. So we'll start with the basics today, basic chapter. So what are the functions of FM? FM is a function of three decisions: financing decision, investment decision, and dividend decision. So these are the basic functions of financial management. If we take all these three decisions in a proper manner, then we'll be able to do a proper financial management. So there are three important decisions of financial management: financing decision, investment decision, and dividend decision. So what decisions are taken using financing decisions? So financing decision will answer to the question that from where to get the money to run a or to start a business. So financing decision क्या सवाल का आंसर करता है? आपको पैसा कहाँ से उठाना है, कहाँ से पैसे उठा के आपको बिजनेस स्टार्ट करना है या बिजनेस रन करना है. दैट इज फाइनेंसिंग डिसीजन. So while taking financing decision, what should be your objective? Objective ये रहना चाहिए when you raise funds, you should always try to achieve that you raise funds at the lowest possible cost. So minimization of WACC, that is weighted average cost of capital, also called overall cost of capital, that should be lowest, also called KO. So what is the objective behind taking financing decision is to minimize WACC. Coming to investment decision, the moment you raise funds, see basically there are two sources of finance to raise funds. One is debt, another one is equity. So once you decide from where to raise the funds, you raise the required amount of money. We'll see in the respective chapters. Then once you raise the required amount of money, what will you do? You will invest. So basically, broadly we classify into two investments: investment in current assets and investment in fixed assets. Correct? From SPM perspective, what do we call them as? One is capital budgeting decision, another one is working capital decisions. Correct? So what is the objective behind taking investment decisions? The objective behind taking investment decision is that you should able to the objective behind taking investment decision is that you should be able to achieve maximum ROI or ROCE, return on investment or return on capital employed. So you raise the money, you do business, you make good investment decisions, then you make profits. So when you make profits, the next question would be, should you distribute those profit to your shareholders? Whether dividend should be declared or not, that is the third question. So basically, financial management is a function of three decisions: financing decision, dividend decision, and investment decision. Collectively, if you take all these three decisions correctly, then you'll be able to achieve the objectives of FM. Now coming to the next question, what are the objectives of FM? FM has two objectives. The main objective, predominant objective, important objective is wealth maximization. The supplementary objective of financial management is profit maximization. Again, this is a very important short note question asked in every alternate attempt. Difference between profit maximization and wealth maximization, or why wealth maximization as an objective is superior to profit maximization. Just to give you a big brief background, wealth maximization always includes profit maximization. Wealth maximization is a longer term objective. Wealth maximization does not only look at profits, it also looks at the growth of the business, and it is a long term objective. Profit maximization, on the other hand, is a very short term objective, very narrow objective. It is only focusing on short term gains and the short term profitability. So profit maximization, wealth maximization, there are two objectives of FM, but the predominant objective of financial management is wealth maximization, which includes profit maximization as an objective. So these are the functions and objectives of FM. Going ahead with the next concept, that's the statement, profitability statement or income statement. So this statement is useful in most of the chapters. So this statement starts with sales. Sales minus variable cost will give you contribution. Contribution minus fixed cost will give you EBIT. EBIT minus interest will give you EBT. EBT minus tax will give you PAT. PAT minus preference dividend will give you earnings available to equity shareholders. If you divide it by total number of equity shares, then you will get EPS. So profitability statement, if you want to mug up, it's very, very important. Sales minus variable cost contribution minus fixed cost EBIT minus interest EBT minus tax PAT. In that you need to pay preference dividend. Then what will be left with? Earning available to equity shareholders. You need to divide it by total number of equity shares, then you'll get EPS. So this is the profitability statement. And whatever is the earning that would be available to equity shareholders, again the company has two choices: either it can pay out all the earnings as dividend to the equity shareholders, or it may not pay dividend and maintain everything as a reserves and surplus. That is retention ratio. So profits, again, they can be paid out as dividends or the company can retain the same. This is the profitability statements. Next, coming to the balance sheet. Normally what you study in accounts balance sheet is different. What we study in FM balance sheet is different. If you come on the liability side, you have something called equity. So equity includes three things: equity share capital, preference share capital, and reserves and surplus. Equity share capital, preference share capital, and reserves and surplus. One thing you should be aware, you should never use shortcuts in ICAI exams. Only for the purpose of revision videos, I'm using shortcuts. You're not supposed to do that. So equity always includes three things: equity share capital, preference share capital, and reserves and surplus. And there's something called debt. Debt means always long-term debt. Please remember, debt means always long-term debt. It may be in the form of debentures, in the form of term loans, or any other long-term debt. So debt means always long-term. And equity on the left-hand side of your balance sheet, on the liability side of your balance sheet, for the purpose of FM, there are two things: equity plus debt. Equity includes three things: equity share capital, preference share capital, and reserves and surplus. And debt means always long-term debt. But in your account balance sheet, on the liability side of your balance sheet, you would have other current liabilities also, which I have listed down in a different color: trade payables, bills payable, expense payable, statutory dues, etc. This will come to the right hand side of your balance sheet in this chapter. Okay, so if I have to write up a formula for capital employed, it is equity plus debt. Coming to the asset side of your balance sheet, on the asset side of your balance sheet, if you see, normally you would have fixed assets and you would have current assets. So all the fixed assets would stay on the right hand side of your balance sheet as it is. That means land and building, plant and machinery, furniture and fixture, or any other long-term asset. That is called fixed assets. And you would have current assets. Current assets in the sense your stock, debtors, bank, cash balance, bills receivables, etc. So these are your current assets. Now I have just drawn an arrow stating that my current liabilities will now come and sit in my current asset side. So again, it will be negative because I'm shifting the liabilities to the asset side. It will reflect in negative. So current assets minus current liability will give you working capital. So if I have to drop a formula for capital employed, it is either equity plus debt or it is fixed assets plus working capital. If you ask me the formula for working capital, it is current assets minus current liabilities. In this way, we'll have to study the balance sheet for the purpose of FM. Your accounts balance sheet has its own relevance, but for the purpose of financial management, this is the balance sheet that you need to remember. Capital employed, that is the total of your balance sheet, is nothing but equity plus debt or fixed assets plus working capital. Equity means equity share capital, preference share capital, and reserves and surplus. And this term equity has multiple alternative terms. The term equity has multiple alternatives. First one is equity is also called shareholders funds. It is also called proprietors funds. It is also called net worth. It is also called owners funds. So the alternate terms for equity are shareholders funds, proprietors funds, net worth, and owners fund. Examiner will confuse you with alternate terms, but you should remember, whenever we use the term equity, it also means shareholders funds, proprietors funds, net worth, or owners fund. So this is the balance sheet for the purpose of FM. Coming to the basic thumb rules of FM, risk and return will always go hand in hand. Higher the risk, higher the return. In all the financial management decisions, whenever there is a higher risk, the chances are there are higher returns. This is the first thumb rule of FM. The second thumb rule of FM is debt is always cheaper than equity. Debt is always cheaper than equity. I'll tell you why in the next 1 minute. Coming to what are the factors that you will consider while taking capital structure decisions. If you want to raise money, what are the factors that you generally consider? So from syllabus perspective, you consider three factors. The major important factors when you consider while raising funds is risk, cost, and control. Risk, cost, and control. So we'll take decision based on three factors: risk, cost, and control. If I have to see on the sources, broadly I have two sources. One is debt, one is equity. Correct? In equity, again, I have three things: equity share capital, preference share capital, and reserves and surplus. On the debt, it is always long-term debt. For now, I'll ignore reserves and surplus. So I'm left with only three sources of finance: equity share capital, preference share capital, and debt. If I do a comparative analysis based on these three factors, which is a riskier source of finance? If you see, debt is a riskier source of finance. Debt is a riskier source of finance. Why? Because debt comes with fixed financial commitment. Debt always comes with fixed financial commitment. Fixed financial commitment in the sense what? Irrespective of the fact whether the company is making profits or it is making losses, whenever you raise money in the form of debt, interest has to be paid. The principal has to be repaid in time. Whether you are making profit or not making profit doesn't matter at all. एक बार डेट से पैसा उठा लिया तो रीपे करना पड़ेगा. That is why there is highest risk in debt. Coming to equity share capital has lowest risk. Why? Because equity shareholders, the statutory, the law says the equity shareholders does not have any right to come and demand dividend payment from you. Payment of dividend is entirely at the discretion of the company. The second thing is that there is no commitment of principal repayment towards equity shareholders. Equity shareholders will only come and ask you money for their repayment only in case of liquidation. Until and unless the company is in a running position, equity shareholder will not have the right to come and ask you their capital back. So because of these two reasons, from risk perspective, which is a riskier source of finance, debt is always riskier source of finance. Why? Because of fixed financial commitment. Fixed financial commitment in terms of what? In terms of two things: repayment of the principal amount and payment of interest. Coming to cost. Cost wise, which is a good source of finance. If you see cost wise, debt is always cheaper than equity. Debt is always cheaper than equity. Why? Because of one reason, that is called tax shield impact. I'll just explain what is tax shield impact in this video only. So debt is always cheaper than equity because of tax shield impact. Coming to equity share capital. Why equity share capital is a costly source of finance? The reason is whatever surplus the company earns after repaying everything. If you come, I'll just come back to the profitability statement. If you see my profitability statement, sales minus variable cost, and whatever after paying preference dividend. If you see here, after paying preference dividend, whatever is the surplus that is remaining with the company, that will be enjoyed by whom? That will be enjoyed by your equity shareholders. So considering this reason, always equity is a costlier source of finance, because whatever return the company earns, the company either will pay it back as dividend or the company may retain it in the form of retained earnings. In either case, who is the owner of those funds? Equity share capital. Equity shareholders are the true owners of the company. So because of this reason, equity is always a costlier source of finance. Another angle to this is that whatever interest I pay to my debt providers, that is tax exempt. So whatever interest I pay on that, I'll get tax benefit. In the other case, whenever I pay dividend to equity shareholders, or maybe to that matter preference shareholders also, it is not a tax deductible item. I'll not get any tax benefit if I pay dividend. Because of these two reasons, debt is always cheaper than equity. Coming to control, if I raise money in the form of equity share capital, there is a more dilution of control. Why? Because equity shareholders have voting rights. So whenever I raise funds in the form of equity by issuing equity shares, the equity shareholders will have statutory voting rights. So in the AGM, in the EGM, they will come and they'll be a part of your strategic decision making. Correct? Any major decisions that the company takes, equity shareholders' consent should be there. But if I raise money in the form of debt, debt providers will not have any voting rights. They're only concerned with their principal repayment and their interest payment. So because of these two reasons, from control perspective, which is a good source of finance, debt is again a good source of finance, because there is very less dilution of control. So to summarize, from risk, cost and control, which is a riskier source of finance? Debt. Debt is a riskier source of finance because of fixed financial commitment. Coming to cost, which is the cheapest source of finance? Debt is the cheapest source of finance because of tax shield impact. From control perspective, which is a good source of finance? From control perspective also, again, debt is a good source of finance. Why? Because there is no dilution of control. There are no voting rights. Coming to in between, you can see preference share capital. It is there in yellow. It is a comparative between equity share capital and debt. If you see, preference share capital is more riskier than equity share capital, but less riskier than debt. Preference share capital, from cost angle, if you see, it is more cheaper than preference, or less costlier than equity share capital. Control dilution is also same. Certain preference share capital will have more voting rights. Certain types of preference share capital will have less voting rights. The detailed discussion is covered in chapter number 2. Correct? If you come down, now I was explaining why debt is a cheaper source of finance. This is a very important concept. Please pay attention. Tax shield impact. So what do you mean by tax shield impact? So on the left hand side, if you see, there is something called a levered company, something called unlevered company. What do you mean by levered company? Levered company means which has debt. Unlevered company means which does not have debt. So I've drawn up two dummy P&L accounts here. Both the sales figures are same, the gross margins are same, the indirect expenses are same. The only difference is that in a unlevered company, there is no tax and there is no interest payment. On the unlevered company, there is no interest. If you see, on the levered company, I have interest here. I have paid interest here. Correct? I have paid 100 crores of interest. In an unlevered company, in the P&L debit side, there is no interest. So in an unlevered company, when I don't pay interest, what is my taxable profit? My taxable profit is coming down to 200 crores. Whereas the tax on which, assuming 30% tax rate, I am paying 60 crores of tax, where in that company, wherein in the capital structure, there is no debt component. But on the right hand side, if you see, all expenses, all income being the same, only one addition what I have done is I've just added interest here. Correct? when I add interest, matlab I have taken debt, on that debt I am paid interest. I have paid interest. I have paid interest of 100 crores. In that case, what is my taxable profit? My taxable profit is coming down to only 100. In this case, what was my taxable profit? Profit before tax was 200 crores. But only because I have paid interest, my taxable profit is coming down. Therefore, it is also reducing my tax liability. Assuming the same 30% tax rate, I'm paying only 30 crores of tax here. So whenever I pay interest, it reduces my taxable profit, and that in turn will reduce my tax liability. If you see, the difference between tax is that in unlevered company I was paying 60 crores, in the levered company I'm paying 30 crores. So therefore I'm saving tax of how many crores? 30 crores. What is this 30 crores? This 30 crores is basically nothing but whatever interest I have paid. What is the amount of interest that I have paid here? Whatever interest I have paid is only 100 crores. On that 100 crores, whatever, on this 100 crores, whatever is the tax rate, that is exactly my tax shield impact. So the more the amount of debt in my capital structure, more the amount of interest, higher the amount of interest, lower would be my tax liability, taxable income, and lower would be my tax liability. This entire concept is called tax shield impact. Higher the amount of debt in the capital structure, higher the interest payment, lower my taxable profit, lower the taxable profit, lower is my tax liability. This concept is called tax shield impact. This is what I was telling you. When I pay interest, it gets debited to your P&L account. Interest gets debited to your P&L account. In other words, interest is an allowable expenditure under the Income Tax Act. Whereas when I pay dividend is a post-tax item. It is just an appropriation of profits. Whereas interest is a charge against profit. Because of these reasons, debt is always cheaper than equity. So these are the basic concepts which are applicable across all the chapters of FM in CA Inter. Apart from this, in chapter number 1, if you see, there are other concepts with regards to agency problem, agency cost. Again, a very important short note. What do you mean by agency problem, agency cost? Just to keep it short, the people who put the money in the business and the people who actually run the business are different. If you see, if you take the example of Reliance, the amount is put in by Ambani family, but if you go to a Reliance store sitting in any other location nearby you, it is not that Ambani himself is sitting in the billing counter, right? People who run the business are different, people who put their money are different, and they both have different objectives. There might be a conflict of interest. This situation is called agency problem. It comes with the agency cost. Again, a very important short note. Another important concept from chapter number 1 is that financial distress and insolvency. What do you mean by financial distress and insolvency? It means you are unable to repay your liabilities in time. Whenever a company is unable to repay its liabilities in time, it goes into liquidation, it goes into bankruptcy, and we need to avoid that situation. So this is the entire revision of basic concepts of financial management. If you have any doubts, please put it down in the comment section. I'll get back to you. And please do share this video with your friends, who it may help them to clear their CA exams. Yeah, bye.